gives me absolute great pleasure to have Professor Michael Mainelli with us for this session on accounting for sustainability. Michael co-founded Zien, a leading commercial think tank and venture firm in the mid-90s, which is designed to promote societal advancement with better finance and technology. What's great about Michael, I like, is his holistic thinking. He is a prolific writer and has published over 50 articles, journal articles, and over 180 commercial articles. Michael's a qualified accountant, a securities professional, a computer specialist, a management consultant, and his education spans Harvard, Trinity, and LSE. Michael, welcome, and thank you for joining us for this session.
Thank you so much, Omar, and it's a real delight to be here with the Global Ethical Finance Initiative, and very much in line with the Chartered Institute for Securities Investment, where I'm privileged to be a fellow honor chartered FCSI. So it's a real pleasure to be here and to be able to speak.
Great. Now, Michael, this is going to be a fantastic session because I know you're going to bring in a wide variety of perspectives, which I think is central to unpacking the new challenges that we're seeing in the markets. So I'm very much over to you to kick off with your opening remarks around this whole thematic of accounting for sustainability and what you see are the macro issues here that frame the challenges here. And then we'll dive later on into the role of accountants and auditors in more detail and unpack that.
Very good. Well, Omar, you're clearly an optimist, because anybody who says accounting for X is going to be an exciting session is a man after my own heart. Yes, I've prepared about 8 minutes of remarks where I just like to set out some of the framework. The first thing I'd like to cover is very much the role of finance historically in the environmental, social, and governance movement. I'd then like to talk about some of the perplexities of accounting in this space. And I'd then like to dwell on something at the end called confidence accounting, which is a long-standing proposal that a number of us have made here in the City of London and elsewhere for reform. But it's a tall order for reform, as I think your listeners will understand by the time I've finished, but it doesn't mean it might not be the right reform. So let me just begin. Personally, my journey up the environmental route really began as a scientific researcher. I was doing a tremendous amount of global mapping in the mid-late 70s, working with the establishment of the World Conservation Monitoring Unit. I moved into the City of London in 1984 in anticipation of Big Bang in 1986. For some people, this might be a little bit surprising because we're talking 36 years ago I entered the city, and I already had my very first debate on climate change. So 36 years ago, we had a debate. That's not that surprising. The theory of climate change is Arrhenius, the late 1800s. The externality of smokestacks is one of the classic externalities. You have the positive externality of beehives, the negative externality of smokestacks, and you've got a comprehensive theory. But we ended that debate in 1984 where we would end it today. Does society actually want to pay? And that was really the case. And even today, people are not fully aware of the sorts of numbers that are being talked about. A lot of large numbers in the trillions are batted about investment, but the costs are also going to be real. And to bring up COVID-19, which I think would be inescapable, we've seen estimates of possibly 5 or 6% reduction in emissions globally with all of this major behavioral change. So we are not going to get there with behavior change. It's got to be deep fundamental economics. I think the second thing is that far beyond my minor contributions, the City of London and the wider financial services sector has taken this much more seriously than people might believe. So for example, in 1953, it was actually the City of London that sponsored the first Clean Air Act. I might also point out that it was the SO2 markets in America, the sulfur dioxide markets, that started and led to the ETS, but I want to come back to the origins of it. If you look at deep economics, a number of American policy wonks in the 80s were discussing the idea of tradable permits for SO2. Okay, cool idea. I think at the time that it was launched, which was roughly 1992, their estimate was something like over 10 years they could knock back the sulfur dioxide emissions by about a quarter. In the event, in 4 years, they halved. And this meant that they entered Kyoto in 1996 and 97, really on a high. This is the way to do it. And they left with a global agreement to put in an emissions trading system. The City of London picked that up right away in 1998. And we published a paper in 1999 on what carbon emissions trading could mean for the City of London. We ran a shadow trading market. We wrote the contracts for it. The EU woke up in 2002-3 and said, oh, we promised we'd have this in by 2005. And we handed them on a plate this entire system written down and with the trading history. I could go on about a number of other initiatives, but I'll pick on one further one. And that was in 2005, we created something called Longfinance's London Accord. And this was an agreement amongst 24, now 60, of the major investment research houses to share investment research for the sake of the planet, to really show how the city looks at things. So huge numbers of initiatives, and I could bring in many other fellow traders in areas like GEFI and all of that. So the city has not ignored the issue, but it goes back to that 1984 debate. Does society really want to pay for it? Anyway, in the course of all of this, we've seen a number of initiatives which have been trying to work effectively extra financial. In fact, there was even an extra financial initiative that was headed up by USS. And as people look at this, it's the frustration that they think they feel with accountancy that leads them to create separate types of audit and accountancy measures that need to be dealt with. So let's just go back to externalities. So an externality is a situation where I am conducting activities that cost other people and I'm not compensating them for it or not paying for it. So it's me dumping my waste on a landfill site without bothering to pay. And the first thing that most economists would seek is to do what they call internalizing those externalities, to find out what's the fair price that compensates everyone for the cost of what I am doing. These are frequently done as taxes, so-called Begovian taxes that are trying to do things, but they can also just be direct costing. And that's what the emissions trading system was meant to be, was that we know the amount that we'd like to issue, we put a ceiling on it, we issue X number of permits to match that, and then we're able to trade those permits and reduce. So all of that is pretty much normal economics. Now, I do happen to be a qualified accountant, and I say this with some trepidation, but the truth is we rarely get the financial numbers right. You don't need to scratch very deeply to find accountants having missed the boat on numerous occasions. That was just last week. So here we are saying, well, we'd like to do finance, but we also want to get into environmental, social, governance, health, well-being issues. And we're going to have statements from the companies that we are going to audit. We're going to come up with different measures for them. And this leads me to what I call the multi-currency problem. We've created all of these parallel currencies, and we're not even good at doing the one that we're supposed to be good at, which is just basic financial bookkeeping. So what qualifies us to range so widely across all of these areas? Further, if you think about it from a moral perspective, we are here selling effectively a free market system. I won't say capitalist, but a free market system with audit and accountability in it. Why shouldn't I be trying to internalize those? And then all of those come back to financial numbers. I'm going to give you a little example of trying to manage people in a firm. So I've got two people working for me, say. One is Miss Goody Two Shoes, and the other one is Harry Henry. So Miss Goody Two Shoes comes up and talks to me and says, "Hey, boss, it's my annual appraisal. How did I do?" I said, "Well, you know, Goody, you lost us 10 million last year." "Ah, but boss, you know, I didn't do any pollution. We had absolutely nothing like that. I don't have anybody in court suing me for their rights. I've got no sexual harassment suits. My team love each other." And I'm sitting there going, of course they love each other. I've just spent 10 million on you. And meanwhile, in comes Harry Henry saying, "Hey, boss, I made 10 million. Aren't I great?" And I say, "Well, you know, Harry, there's a few problems here. You've got 4 sexual harassment suits. You had that copper discharge into the local river. And I'm afraid actually you're now on the evening news because you're using forced child labor to make our product. And I don't really like this. Well, the two of them are going to turn to me and say, okay, boss, you tell me how much is child labor worth against my decreased profit? And Goody Two Shoes is telling me, what do I need to drop, boss, to make a profit? So in a funny sense, it all comes back to money anyway. And so it would be good if we could find ways to internalize those externalities. So I start with that in the round, and therefore that leads, if we're trying to account for ESG issues, then we want as much as possible to use the whole economic system, get the political system to internalize these externalities so that they're well costed, and then use the tools which we're supposed to be good at, which is straightforward financial audit and accountancy to deliver. And therefore, I would contend that any efforts to look at separate accounting or measurement issues by accountants should be only steps along that road. It's not to say that they're wrong, but that they should be steps along the road. So things like carbon accounting are good, but it would be far better if the price was there. If the price was there, I don't need to ask you what your carbon emissions are. I won't purchase your product if it's too expensive. And you say, but my product's so expensive because I'm burning a lot of carbon. Well, go fix that. I don't care where you purchase your paint from. I don't care how you source your labor. It's your bit to get those costs down so that I purchase your product. And I think that's far more influential than having analysts looking at these subjects or anything else. However, this leads to one area which causes problems, which is the variance in all of this. And one of the points I've often made is that accountants are very, very poor at examining the volatility or the increased certainty of actions. So a lot of efforts that companies might make in the ESG area, setting up, for example, an ESG unit, working with people who provide social and ethical labeling, or getting audits done on other facets of their business through, for example, ISO standards, a lot of things like that. Most of these are ignored by the financial markets because we are not incorporating them in the numbers that the accountants give to them. So let me give you an example. When I'm looking at a business, any business, it's got some sort of range of outcomes. Imagine a distribution function, a normal function, whatever. And arguably at a very abstract level, there are only four things you can do. One is you can say, I don't want to be in this market at all. So instead of making trainers, I'm going to go off and do hand belts or something. I really just don't want to be here. But once you're in that market, you're looking at this distribution function, that leaves you with only three things you can do. So the first thing you can do is you can kind of move it to be a little bit more positive. And that's all the traditional management techniques of training people, reducing costs, etc. Second thing you can do is you kind of lop off the bad stuff. I can insure against a fire or insure against a pandemic. So that's fine. What's left then? Well, what's left is actually tightening that, reducing the volatility of that. And accountants tend not to take that into account. So if you look at shareholders, interestingly, and people focus a lot on share price volatility, but actually it's well known that shareholders actually like profit stability as well. In fact, if they didn't like it, why would management spend so much time trying to smooth profits over years? So they would like to see reduced volatility. And many ESG issues are actually about future reduced volatility, which we can value, for example, using option theory. So, but how am I going to find that on the state of the accounts? And the answer is I won't. So to me, a proper, well-structured balance sheet ought to be showing me the distributions. So if we take something like the value of freehold land on the accounts, we know we can go and have a look at that. We'll find a single point and we'll laugh at the spurious precision. How can they estimate freehold land at 11,497,000? They had to sell it tomorrow, they'd never get it. If they held on to it for 2 years and got planning permission, it could be worth 4 times that. So you see, but we accountants stick that as a single number on there. We don't represent the range. In other words, we lie. And this, to me, is one of the most disturbing things because oddly, very oddly, an approach which would be to move from single point bookkeeping to representing ranges would go in line with the direction of the profession in terms of risk management and looking at that, combining the forward-looking risk with the backward-looking. The second thing it would do is it would allow some of these ESG issues to be incorporated. So, for example, I am looking at a product where I can see changes in the production techniques, say plastics, and my problem is I can see that over time my plastics area could be more dangerous for me. I'll be having to pay a lot more for plastic disposal. So what am I doing about it? My accountant comes in, my auditor comes in and says, actually, you've been doing better than your neighbors, and therefore your range going forward is smaller. And in fact, oddly, we'd also wind up with better accounts. We conducted a survey, we conducted a report with the ACCA and the CISI a number of years ago, where we looked at applying this to the historic accounts of RBS before its fall, and we found that we would have reduced the number of pages in the RBS accounts from just under 500. We would have reduced them by about 100 pages. Why? I thought this is more complicated. No, it's not. If you really read the accounts, you'll find that there were 100 pages of footnotes saying we picked a single number, and that's the number you see there. And we picked it on all of these rules and regulations, and we looked at this as the lower of that and the higher of that, the less the cost of such and such. Right? So there's all this waffle filler at the bottom of the page to say we should have put down a range here, but we didn't. And if you put the range down, you're kind of done. And this could be as simple as on the sheet. It doesn't need to be complicated risk management. You could simply say, as I often express it, bet percentages. What's the bottom? The freehold land's worth at least 8 million on a bad day. What's the expected? 11 million. What's the top? BET, tops maybe 15 million because I could see planning permission. And the percentage. What are the odds that the range is in there? 95% would be a typical type of approach. And for the first time then, I'd actually be able to measure audit quality. So instead of talking about our audits are great because we have expensive people doing expensive processes, have been going backwards in productivity for 20 years, which is the real case, I'd actually be able to walk up to a firm like your former firm, Omar, EY, and say, I've looked at 100 audits you've done over the last 3 years, and actually you were too tight on people. At the 95% level, only 2 of them actually breached it, so you're kind of a bit too hard on them, perhaps. Or 10 of them were out of range, completely out of range, and I'm afraid you're not a particularly good auditor. So I'll pause there, but to me, believe it or not, this approach of confidence accounting is important for the auditing and accounting profession, but also is a way to incorporate ESG materially into our numbers.
Well, that's really interesting, Professor Michael, because you're pulling up a lot of issues here. So we're saying, you're fundamentally challenging whether the accountants are best positioned to do this because of past performance, and just within their accounting realm. But we know, and you've talked about, the singular number versus a range, even you refer to it just as a lie. Now that's really quite challenging. So if we just take for a second the fundamental role of looking at going concerns, which has come out from your reference to the future issues, and if we take risk, all of these factors now, the way the science and the data has proven it out, climate change, loss of nature and biodiversity loss, surely these all have a fundamental impact just on supply chains, which could impact the company's time horizons as going concern issues and so on. So just within the existing postulates of auditing and so on, what are we seeing directly related to that in terms of the ESG issues as they've arisen now? I mean, now you live in a period where data through social media is instant. It's transparent. You can go around the world. If you're found to be using child labor in sweatshop conditions overnight, your stock price will get hammered. We've seen that with Boohoo recently. We were, in the top 15% of their, according to the MSCI sustainability index of their peers. So just within those issues, Michael, what's your thoughts? How is the industry having to deal with that, and have they been dealing with it correctly historically? Before we go out to understand and account for other multi-currencies, I like the way you frame that. So before we go to the other currencies, just within the heart of their realm.
Just within the financial numbers, yes. Omar, you put your finger on a really good point here. When you think the profession and in fact the entirety of finance is often criticized for being too short term. It's often that it's far too short term, and we seem bound into a peculiar annual cycle because for some reason our planet orbits some star and does a circuit. And a lot of the problem, I think, with the instant data is a bit like instant coffee. I really don't like to drink it very much because it's quite ephemeral and fast. And so I'm not a particularly big fan of this sort of instantaneity resulting in the numbers. In fact, to some degree, one might argue that's part of the problem with financial markets. Do they really go up and down in value 20% in a day as they have at particular times? I mean, some of this does seem insane, and this leads to some of our very peculiar battles in the profession. I don't want to get too technical, but if you look at a lot of the things about intangibles on the balance sheet, there's sort of a very peculiar paradoxical circle to it. So it starts off with, here's what's on the balance sheet in the accounts, here's what the market says it's worth, explain the difference. Well, the market's difference is based on the last traded share, ramped up for the entirety of it. So that's kind of looking at the marginal bit there. I know perfectly well if I tried to sell half tomorrow morning, I wouldn't get what the last traded share was worth. So that alone should get you a bit scared. But then I try and carve up this difference into quality of management, brand reputation, intrinsic know-how in the business, processes, etc., as many people have done over the years. Well, then these values are swinging wildly on every daily movement. We know that's not true either. Did the management become 20% more competent overnight and then 20% less competent by the afternoon? That doesn't stack up. And why did we do all this? Well, we did this because the accounting numbers don't match the market price as badly applied. So as we look forward on this, one of the things that take your supply chain example, which is a particularly good one. If I've got rickety supply chains, confidence accounting would mean I put my supply chain somewhere on the balance sheet, or I put my freehold land on the balance sheet if I'm sitting next to, some sea level type estuary. And then the accountant would say, well, the value of this is actually much wider than you think. Why? Because if you had to sell it in years to come, it's actually at high risk. If I sit it on a mountaintop, let's assume the mountaintop's safe, the accountant comes in and says, yeah, I can see where your value of your freehold land is pretty stable because you're not at risk. So it would be incorporating a lot of future perceptions into the current numbers without actually changing them. Because remember, expected is what we currently do anyway. It would be just putting the bottom and the top in and saying how confident we were that we were within that range. And there'd be a good struggle because management would want to be tightening that range, and the auditor would be wanting to extend that range to be sure that they weren't caught out, as I said earlier, on post-measurement of the quality of their audit.
So do we think, so Michael, go back into the auditors, if there was, you touched on the systemic issues and the approach, but if we were to start this journey and stay on this path, as you said, what do you think are the first, 2 or 3 things specifically you would like to see happen in the next 5 years? We're entering the decade of action for the SDGs, so we now need to come forward with practical solutions. So is it we know there's initiatives for non-financial reporting standards coming out. Is it more disclosure? Is it an actual hit on the P&L, not just the balance sheet, taking account for these externalities? And we've got attempts at natural landscape accounting. We know the Scottish government, for example, have recently valued the natural land in the country. So what would you say that the most critical 2 or 3 things that you would like to see happen, and based on the experience of the City of London, which you said earlier from the 1950s, has actually practically tried to put the carbon emissions and numbers around that? What would you like to see, and you would say is absolutely critical if we are to begin to materially progress here?
Well, I would pick broadly 3 things. The first is we as a profession, I think, have to be much clearer about our views on this. So I clearly sit on the area where I say our job is to first, when it comes to a policy issue, before we get to the accounting numbers, to start with trying to internalize those externalities, that our bias should be towards economic approaches that do that. So we should be pushing for carbon pricing, not for carbon accounting. what we know about carbon, to tear off your energy bill and hand it to a proper engineer. I'm not going to hand it to PwC or KPMG to deal with. So I think we should be looking at internalizing those externalities. And then when it does come back to us, we see it as your cost of carbon was $37 a ton or euros a ton or whatever. Here's the bit, you're a bit of an idiot, because if you look at the cost that your neighbors are paying, they're not paying this. So competitively, is this where you want to be? So that's the first thing. And I don't think we've had that debate. And part of that is, if I can be frank, vested interests. We love this stuff. We absolutely love the requirements. We've got chairmen and boards have to make all of these statements. Sadly, there was in fact a study done about 8-9 years ago where they gave analysts corporate reports and a bit of a time pressure to analyze them. Do you know what they did? They ripped the front half off and threw it in the bin. They went straight to the numbers. This is real academic research. Went straight to the numbers. And what did they do with the numbers? Well, when they had 3 or 4 businesses in the same area, they tried to put ranges on.
Right.
So we're going in this circle where we throw the data away because we want a single point number and do it. So anyway, we should be internalizing externalities as our de facto ethical stance, in my opinion. Having done that, we've got a job to do. And I've pushed for confidence accounting. But funnily enough, this doesn't necessarily require legislation. It certainly doesn't necessarily require changes to the rules. It could start as just a change in attitude. So Andy Haldane, in fact, wrote the foreword to our report on confidence accounting. As I say, the ACCA is behind it. The CISI is behind it. We've had articles published in ICSA magazine, the ICAEW magazine, the CIFA magazine, and the CIMA magazine. So everybody knows about it. How could you get it going? Well, quite simply, you would just simply, as an auditor, working with the management, say, would you just like to publish these ranges? And there's absolutely nothing that prevents us doing that. Absolutely nothing whatsoever. It's just an informative statement that we could make. So that would require, I think, the profession to want to improve, but it doesn't necessarily require changing the ground rules. So that would be the second thing that I would like. And I think the third thing I would like us to see is being much more honest with people that if you want us to look at other things, we will. I mean, as I said, there can be stepping stones along the way, but that our ultimate goal is to get it out. So please don't be trying to give us more business. At the moment, the profession of ESG, the green bond market, there are a lot of jobs for the boys and girls out there without actually getting a lot done. So we keep a lot of professionals in business. And as I say, remember, audit has actually gone up in price and down in productivity over decades. We're making a lot of money out of it, but that's not helping society.
Interesting. So would you say then, I want to go back to this point about time horizons, that we know it just fundamentally seems to be a systemic issue here. Going concern, how many years is the going concern prospective time horizon from auditors?
It depends. In fact, it's woefully imprecise. I'm not a technical auditor, but I remember when we were doing a lot of this work, one of the problems we faced was that the convention is that it's about a year. And the more I began to look at that, the sillier it began to look to me. I mean, I could actually be in businesses where 3 months is the best that I can do. Why can't, in fact, I think accountants should state that. I'm very happy to give you a going concern, but only for 3 months. But there's this presumption it's about a year. And actually, I might like to know for particularly long capital intensive companies, are you really going to be around in 6 years? Now, the auditor, quite rightly, is going to fight back on that and say to the company, excuse me, I'm not giving you 6 years and this is really rock solid. But those sorts of debates, in my opinion, should be had. And confidence accounting would exacerbate those debates a bit, which is a good thing.
And if we were to link that, do you feel, is that possible that the fundamental issue of short-termism within the financial markets and the capital markets that we have, if we were to link disclosures or potential scenarios and implications of that, and even put a kind of costing range on that in terms of the hit to the company for 5 or 10 year horizons, is that something you feel would be a useful addition to the current disclosures, or are we already there? Or
but we're certainly not there, and I think part of the problem with the current disclosures that I indicated earlier is they're not really disclosures in a financial sense. The short-termism issue is not just based on the numbers, or I think it would be solved. There are a whole bunch of complex moving parts, starting, let's be frank, with basic human greed.
Yeah, exactly.
Then we move into, what governments are doing on monetary policy, which pushes up asset bubbles and things. We move on to the way in which everybody's been moving towards ETFs, tracker funds. So there's a lot of issues out there. So I'm not claiming this is a cure at all for short-termism. But what I will say is bringing the long-term numbers into the present must be of some help in saying to people, you've got to take a slightly longer term view than, can I flip this share as I'm trading my shares anyway 10 times a year in total. It's got to be ways of stopping that sort of behavior. So
you mentioned greed there, and often the words confidence, financial markets are driven by fear and greed, and the confidence that's meant to be injected by the accounts, which are the principal, if not primary, possibly only source of validated financial numbers, which are somewhat internationally comparable. Coming on to that human piece of it, in a quant-driven, numbers-focused market, with the broader societal change towards purpose, so you see it here in the narrative of moving from profit with purpose or profit through purpose, whichever way it's being framed by different institutes. So purpose alongside profits. How do accountants or other stakeholders, for that matter, feel free to comment, deal with such qualitative factors without a fundamental kind of ontological change here?
Yeah, well, I think I am proposing to some degree a fundamental ontological change. I mean, the example I give is I happen to sit on the board of the United Kingdom Accreditation Service for many years, and we are the scientific organization that handles the, I think it's 3,500 laboratories around the United Kingdom, 800 certification agencies, everything to do from lighting systems, braking systems, on-fire carpets, you name it. We get into ISO 9000, the risk management. All that is done not by auditors in the financial sector. And by the way, we do this with a regulatory body of about 250 people. And nobody ever asks, how's the rest of the economy work? Kind of scary when you think about it. And all that. Why do I go on that? Basically, none of the major accountancy practices would be qualified to practice in our space, because we always require the scientists in the lab to produce ranges. There's no such thing as a single accurate number. And then we test them on the repeatability of that. So the whole profession needs a look. Now, to give the profession a little face-saving out, I mean, the truth is the history of accountancy is just after about 1100, a bunch of Italians are dealing with a bunch of hairy northerners who don't use olive oil, they use butter, they don't drink wine, they drink beer, up in largely Belgium today. And they needed to handle these non-family members, so they invent double entry bookkeeping. About 300 years or 200 years after that, we see Fra Luca Pacioli decides that he's going to codify it, but it actually existed for a few hundred years before that. And the last change to that system was, oh, well, never. And so, as you see now, and to be fair, as accountancy grows, particularly out of the United Kingdom and Scotland in the 1840s, it's doing this bookkeeping paradigm. Metrology, which is where scientists suddenly wake up to the idea there is no single measure, is largely a movement of the late 1800s. So I'm not saying accountants are stupid, but we have had now 130 years to kind of catch up. If we want to call ourselves a measurement profession, why don't we do a little bit of studying of measurement science, which says that's the way that you measure things. You set a range and you put a confidence level that you're within that range, and you look at the replicability of it. Now, I know a number of accountants out there who've passed their exams will say, oh, we do that with stock. Well, that's sweet, but I'm actually talking about doing it across the range of things. And even on stock, we don't publish it. It's the method we use, and then we throw all that out and we put a single number in the accounts again. So I would like to see us being much more open on that. And to me, that is a real ontological change.
And is it driven by some desire to fundamentally allow comparability and to it's what they've made things simplify at the expense of actually showing accuracy or of the data. Is that what's driving this? The singular desire for a singular number?
I think there is a bit of fear here. Well, there's always a fear of change, but I'm going to ignore that. There is, I think, and it's, you know, unless I sit down with a technical accountant and get a good 45 minutes with them and actually show it to them, there is the, oh, Aunt Agatha won't understand it. Quite interestingly, as one of our tests, we in fact ran a small session with 12-year-olds, not a joke. We had them run a mythical lemonade stand, and at the end of it, we asked them how much profit had they made, and they were great because they said, well, you know, we don't know. You know, if we're going to open tomorrow, it depends if it's sunny or not, how much our lemons are worth. You know, they were actually up for it. And when we showed them the lemonade stand done, you know, it was only on one sheet of paper, I hasten to add, they were 12. They understood that far better than they understood the single point numbers because they knew that the ranges were in there. So, and as I said earlier, and Agatha will get 100 less pages on, you know, on RBS accounts anyway. So that's a 20% saving. So it is clearly simpler, but accountants don't think it is because we're very comfortable with accounts the way they are. I know how to read them. I go into them and bury through it, but the ranges would be a change. I think the final thing is, of course, it would also, as I say, expose accountants to the quality of the audit. And it would also heighten the challenges of management to them and of auditors back to management, which personally I think is a very good thing. It's become a little bit cozy. Remember, we've got a product that is late, overpriced, that management these days really don't want because it's late and it's overpriced. It doesn't do them any good particularly. And then we claim that, you know, we're great professionals. I think it's time that we moved and tried to actually help society by providing the type of data that society needs to make these longer term decisions.
So I want to go back, Michael, for this kind of final piece of this discussion. Picking back up now on, I know you refer to kind of taking the set to costing, not accounting, and staying within that realm. But then how do we, from that risk perspective, deal with these qualitative factors? So, for example, the S in ESG is increasingly becoming more and more relevant. We see movements, you know, recently on ethnicity and gender and so on and so forth, and equality around these factors. How they do fundamentally present a risk to the company, because if you get it wrong, your sales will plummet. The market will shun you immediately, instantly on social media. You can't say, you know, again, we look at the Boohoo example. So this is a real tangible commercial risk to the business, let alone the moral position which companies should be taking, or maybe they should be void if you take the Friedman, you know, it's quasi-Friedman role on that to some extent. But it's how then, in your view, do we start unpacking this S within ESG, these qualitative factors? Because there's not a range here anymore. We're moving beyond numbers within a range. Is there some other range, or is there some other methodology? And yeah.
Yeah, it's great, Omar. We are moving. Ulrich Beck wrote a book, I think 30 years ago, called The Risk Society, about how society is moving towards this risk element. We've seen this as well in the pandemic. You know, why doesn't the government have it? And in fact, there are moves at the moment in the city for things like Recovery or Totus Re, where we would actually start managing national risks more sensibly. I've been deeply involved in the clinical negligence scheme for trusts, the terrorism reinsurance, and some of the insurances to do with cyber, where we're trying to see how we can handle these big risks in there. So society is moving this way. And let me give you an example of this. It's so weird, but it's true. We had two companies, both of them British, and both of them in the telecom sector, and both of them asked us how much was ESG worth to them, which I think is kind of where you're driving. And in both cases, they had about 10 people in their ESG unit, and it was costing them just over $1 million a year or something. And I'll take two risks to use your bit that they face. So the first risk is the risk that the handsets might cause cancer. Okay, there is some risk in there. The medical stuff could come up, but separately, they agreed that this would hit all of their competitors equally. So drop $1 million on a brain cancer charity, to be crass, and there's not much more you can do about it because you're buying the handsets in from the major providers anyway. And if you get hit, well, everybody else in the industry is hit. But the second thing they had were things like locating masts. And again, I'm no proponent of this, but it is known that some people believe that mass sightings can again lead to various forms of ill health. One of the telecoms companies was siting their masts near schools, and the other had a policy of staying far away from schools. So there you go. So that's a classic kind of ESG problem. Under confidence accounting, the auditor would have come in and said, what about the risk? Which is, by the way, probably negligent to zero, sorry, not negligent, negligible to about zero. But nevertheless, saying, what are you doing about it? Well, we wound up doing that. So the company who had sited its mass away from schools, we were able to say, well, if you'd sited them at schools, so you had, this was at the time when they were buying them up, if you had, what would you have saved? And they could put that number down. So I said, you've already put a price on that risk. You've already done it. And what are the odds that you were working on? And from that, you can actually work out an option theory of reduced volatility that they believe. They believe that siting these masts away from the schools would reduce that volatility I spoke about earlier, that were this to become an issue, they wouldn't be hit as badly as the other one. And in the case of the other one, which was saying, well, we've located them there because it saves us a lot of money, they too were able to say, my risk is therefore probably higher, even though I don't think the risk is significant. My risk is higher, and they would have had a wider range. And this, again, brings these things back and forth. There's one final thing I might mention in this space, and it's an exciting one for me, and that's policy performance bonds. Now, policy performance bonds were a proposal that we put forward for managing some of these long-term risks about 15 years ago, and it got poo-pooed. And the idea behind a policy performance bond was you said, these are the outcomes that I want, and I will pay a higher interest rate if I fail to meet them. At the time that we proposed it, the only real example we had was inflation-linked bonds. An inflation-linked bond is that the government says, I'm going to keep inflation to X, say 2%, and I will pay you a percentage point for every point I'm over that. You don't know how I keep inflation low because it's not that simple. It's about productivity. It's about import exports. It's about the way the central bank runs itself. There are a lot of things in that. But basically, it's our job to keep inflation low. If we fail to do it, we'll pay for it. First outing of those was in the 1700s in Massachusetts, where they had a basket of beaver pelts and some other things. It was quite amusing. So a known policy performance bond, and we proposed that these could apply to ESG issues. I didn't get much traction here in the UK, but the French government asked me and a colleague of mine, Jalal Bouzidi, and we wrote a book in French a few years back, which took off, as much as books like this take off, on new environment for the finance for the planet. And in this book, we laid out a number of options for deploying these. Just over 2 years ago, Danone and Louis Vuitton issued these bonds. Enel in Italy has issued them, Nokia has issued them, and now they're being issued in abundance. They go by some other names sometimes. Sometimes they're called sustainability linked. Some of them are called positive performance bonds, but they're all tying things to that. And to come back to the S in your question, interestingly, a couple of the companies have issued them where they put S in it. So firstly, I see quite rightly the SDG pin in your lapel. And Enel has issued them against their own SDG targets. I forgot the name of the company. One of the companies, that might be Enel as well, has actually looked at the number of women in senior management positions. So if they fail to get the quota of management positions filled by women that they achieve, they will pay more on their bonds. Now, this is great. I now don't have auditors writing reports. I've got a market bond out there against my target. The investors will price that, and you can see whether I'm meeting or not on a minute-by-minute basis if that's really of interest to you. And this obviates the needs for setting up that separate currency of women in management positions that I report in the annual report and do anything about. I've really put my money where my mouth is.
So these are like the social impact bonds that we've seen in the UK. Is it similar to that, or
A number of people say that. Actually, they're kind of fundamentally different. These are, social impact bonds are about encouraging NGOs and local communities. There are elements that are similar in a way, but
purchasing the outcomes.
Yeah, but these are just very straightforward. You lend me money, and of course, the great thing about we're a government to issue a policy performance bond. I mean, we have COP26 coming up your way in Glasgow.
Yep.
Next November. We have a net zero target in the UK, net zero by 2050. That's a 3.3% a year drop over 30 years. Issue a government policy performance bond that says if the UK 2 years in, it should be 6.6% down. If it's more than that, great. If it's only 5% down, the bond pays 1.6%. What's interesting about that is then you do not need to hedge using fossil fuels. You can actually hedge against the government's own policy target, which is. And the other thing that's kind of interesting about them, there's been a rising debate. To be honest, I wrote a small paper about this back in 2006 or so, but about the looming kind of carbon wars, where in these trade negotiations, I say, you got the wrong kind of carbon system, I've got one, and all that. Actually, you could see governments issuing, you'd pick some rough norms, but say at least 10% of GDP needs to be in a net zero bond by 2050, and it has to constitute, say, at least 15% of your government debt. Now you and I are discussing why I'm not importing from your country and you're not importing from mine. You bring up my nasty carbon stuff, and I say, wait a minute, Omar, I've issued a net zero bond. It's trading identically to yours. So our tariff rates are equal, 0 or whatever. If I'm over, we could tie that to the free trade agreement. And I don't need to get into how you do it. You don't need to get into how I do it. We're just looking at the outcome. A bit idealistic, I know, but then those who think that they're going to get a global compact that's binding, I think are equally optimistic, if not worse. So this is one proposal that might make some sense also at a governmental level.
Yeah, I know Khazanah in Malaysia issued a bond in the education system where they would reduce the cost of financing for higher education institutions if the performance of the grades was better. So it's a similar principle.
I wasn't aware of that. Thank you.
Yeah. So it's final piece, Michael, from you. Thinking beyond GDP, how would you measure well-being and happiness? Leave us on that note.
Oh wow, it's a lovely and rich subject, I know, and I think that ultimately it cuts to the heart of some of the sustainability debate, because and COVID's a good example of this. I think we're going to be seeing a lot more debate. At the moment, about a third of the UK is living off the government, 9 million on furlough and 2.5 million or so on unemployment out of a 30 million working population. So I think COVID has been very good at having us all take a little bit of a reset about what do we really want from life. Now, it doesn't make it comfortable, but it is there. So I think we could see some debates there. I think the second thing is that we really do need to, in my opinion, stop looking so much at GDP as the only number. So that's kind of the lead into your question. On the other hand, you then hit a bit of a break here. Obviously, the poster child in this space is Bhutan with its well-being index. Sarkozy, was it Sarkozy? Basically tried to get the French government and two economists, I think Omar Shaikh was involved, to look at how could they measure it. We in this country have often talked about a well-being index. I think ultimately it's not that hard, but it ought to be, I think, creating a set of maybe 5 or so key long-term indicators. So education, by the way, would be an extremely good one. Meeting your net zero targets would be a particularly good one. So that's education, and the environment. Pension stability, I'd oddly put on that list as a potential one. What is the genuine provision? And I would also put on there some good quality of life indicators from health. And if you think about it, if you look at, there's a lovely book out by a friend of mine, Jim Briding, called the S8, the Small 8 Nations. So he's looking at Switzerland, the Netherlands, Sweden, Ireland, and what he points out in that book, which really hit me between the eyes, was that these are the 4 areas people get right: education, the environment, pensions, and health. These are the long-term areas, and all 8 of these countries outshine the bigger countries in that regard. So I'd like to see all of those numbers alongside. And then instead of focusing on GDP, I'd really like to look at the purchasing power of the households, because that's what the households care about. Is, if I can get food in, that's great. If my GDP per capita has gone up 20%, but I'm still scrambling to try and get bread on the table, this is not much use to me. And the chap who came up with GDP, I believe it was Kuznets in the 30s, he at the very, I've been asked to do this in the US as part of a statistical exercise, but please don't put all the weight upon it. And that's what we've done for nearly a century, sadly.
Great. Thank you very much, Professor Michael Mainelli, for sharing your fantastic insights. Much appreciate your time, and that's been a really enriching session. Thank you.
Omar, thanks for having me. It's very kind of you.